The 2024 Reconstitution of SCHD just happened and it brought major changes to the ETF. Is it for better or for worse? That's what we will explore in this video. Hi, my name is Ognian and welcome to the channel. So let's get straight to it. The Schwab U.S. Dividend Equity ETF recently announced their yearly reconstitution, and it was a major one which might have lasting effects on your portfolio. Before we dive into what exactly they are, let's first answer the question, why are they doing that? Well, every ETF, which is basically a basket of stocks, needs to update its portfolio according to its rules. It obviously cannot do that every day because it would be a total mess and create a lot of transaction fees, so the ETF providers do it at set intervals. For SCHD, this happens in March. Now, something very important to understand is that they are done by an algorithm. I have seen a lot of people commenting on whether SCHD's management knows what it's doing, or that they are fools or geniuses, etc. You have to understand, there is no such thing as SCHD management. This is not an active fund where you have a bunch of people getting in and out of stocks based on their analysis of the market. It's a passive ETF and Charles Schwab is its issuer, but not a manager. What SCHD does is it follows the Dow Jones U.S. Dividend 100 index and tries to replicate it automatically as close as possible. We will talk about the index in a bit, but I just needed to get this out of the way for you guys. Okay, so what are the changes? This year, they were pretty big. Almost 25% of all the stocks were eliminated. Here is a list of stocks that were removed. I'm not gonna go through all of them, as you can pause and see the list yourself, but just through some notable ones. We first see that the top stocks comprising 10% of the fund, Broadcom and Merck, were removed. A lot of people were not happy about that, as they were really good performance. Broadcom has been on a tear recently with 114% increase in the last just 1 year due to the AI and semiconductor boom. Merck has also been doing okay with a 17% increase in the past year. So a lot of people who don't have a clear understanding of how SCHD works started saying that the managements are idiots or that shouldn't have happened, etc. Which brings me back to something I have been trying to hammer into the heads of my YouTube subscribers as well as the students in my dividend method program. You need to know what you invest in. As mentioned, SCHD tracks the Dow Jones U.S. Dividend 100 index. I'll give you a brief explanation why these companies were removed by explaining a crucial point in the index. I won't do a full review of it since this is part of my almost 40-minute complete review of SCHD I did, for which you can find the link in the description and also at the end screen of the video. For now though, what you need to know is that apart from all the other screeners, the most crucial piece that explains what happened this year is that stocks are ranked in descending order according to their dividend yield. Then only the top half, which means the stocks with the higher yields, will be left in the index to get ranked by the other filters. If we go back to the Broadcom and Merck information, you can see that because of the price increase in the stock, Broadcom's dividend optically fell to 1.56%. I say optically because they did not reduce their dividend, but simply the percentage of the share price that got paid out got lower as the share price increased. Same happened with Merck. So now that you know that stocks are ranked according to yield, you can see why a 1.56% yielding Broadcom and 2.49% yielding Merck would not make it into the ETF. It's just how the algorithm works, and if you invest in SCHD, you need to be fine and aware of it. It is why I'm not a huge fan of ETFs that rank companies higher if they have higher yield, because you often miss out on great growth stories. I have such ETFs, and I understand that if we want a higher starting yield, we need to make that sacrifice, because in order for the fund to secure it, they have to have some screener that gives priority to higher yielders. But at the same time, I always prefer to have additional quality screeners. In the case of SCHD, we have them, but I won't include them in this video in order to keep it to the point. You can see them in my full SCHD review I mentioned. Okay, so another company that caught my eye from the removed ones is 3M. This is something we've all been waiting for, as they are really in a bad spot. I sold all my 3M shares back in the summer, and I did a video about why I did it, which I'll link somewhere around the video, either in the top corner or the description. They have a lot of issues with 2 major lawsuits, and they have been increasing their dividends by pennies only to keep their dividend king status, which is always a warning sign for me. Okay, so let's see what are the companies that came in the place of the removed ones. The first one is BMY, which has dropped in price by almost 23% in the past year. As you can see, that drove the yield up to 4.65%, which obviously combined with the fact that they passed the other screeners included them in the fund. The second company was HSY, the Hershey company, which has also dropped significantly in price. So we can see kind of a pattern here. I don't have time to go through all the stocks, but it is important if you are investing in the ETF to dig a little deeper and find out whether at least the top companies have been included because they are undervalued right now or because they have deteriorating business, which causes investors to sell, which drives the price down, which makes the yield goes up. If SCHD was a big part of my portfolio, I'd certainly want to dig into that. So, moving on to the current situation with SCHD's portfolio. We can see that the industrials dropped quite a bit. At the time of doing my review a couple months ago, they were the biggest sector and now they are down to the fourth position. Financials are up to the first place and we have healthcare and consumer staples as second and third. The top 10 companies, which make up almost 40% of the fund, are UPS, Texas Instruments, Cisco, PepsiCo, Pfizer, BMY, Lockheed Martin, obviously they need to produce a lot of weapons, don't they? Home Depot, Chevron, and BlackRock, which is a kind of inception because Schwab has an ETF that owns BlackRock, which is another ETF provider and asset manager, and they probably have some ETFs that own Schwab, but hey, that's the world we live in. As I look at the list, I see some solid companies which I also have in my portfolio and which I'm bullish on, others not so much. Speaking of which, if you want to see my top 4 stocks and ETFs for the current economic and geopolitical environment we are in, go to the link in the description and I will send them to your email address for free. The report will always be up to date regardless of when you are watching this because I'm constantly updating it. Okay, so let's talk a bit about what changes do I see in SCHD and what it means for the overall portfolio. First, the yield of the fund will increase as a result of these changes, but it will limit future dividend growth as fast growers like Broadcom were removed due to their lower yield. That limits future earnings and sales growth for SCHD. Now, it might be disappointing to some people, but you need to remember why you own SCHD. The goal of the fund isn't to beat the Nasdaq 100 when it comes to growth. If that was the case, you would have owned QQQ, wouldn't you? The goal of SCHD is to expose you to the largest value companies in the USA, not the ones with the biggest capital appreciation for which you would buy the Nasdaq or the S&P 500. Its goal isn't even to expose you to the ones with the highest dividend growth for which you would buy something like DGRO. This was always supposed to happen because of the selection of the top half of the stocks from the selection universe that pay higher dividends. I mean, you wouldn't think a company like Visa, MasterCard, Nvidia, Microsoft, or Apple with their sub 1% dividends would get into the fund, right? So while this was always expected to happen, it marks a major shift in SCHD's portfolio, which you need to be aware of, which is why I made this video. If you want more help on your investing and personal finance journey, I invite you to join my free investing masterclass, for which you can find the link in the description. So basically, this year's reconstitution for SCHD was massive and it might lead to lower dividend growth for the ETF than it has had in the past years. Whether this will happen or not, I'm not sure, but it's important for you to know what you own and the strategy the fund has behind it. In order to learn everything you need to know about SCHD, I suggest to watch this video that should have appeared on your screen, which goes deep into the ETF and the index it follows. I'll see you there.